We're jumping straight into the aerospace company Rocket Lab today.
Yeah.
If you've been watching the markets, you've seen the crazy price action, the volatility.
Right.
That massive year-to-date rally, we're talking 175% plus. But honestly, focusing on the daily swings, you're missing the real story.
You really are.
The big picture here is this strategic pivot they've made. It's now cemented. They're moving deeper into defense, into space systems, and a huge new contract just proved it.
That pivot is the critical context you need to understand right now.
Right.
If you bought this stock a couple of years ago, you were betting on, a launch provider, a small payload alternative to SpaceX.
Sure.
Today, that thesis has completely changed. They're becoming an integrated space systems company. They build the rockets and the satellites.
That integrated approach, it changes everything. How you look at the financials, the risks, all of it.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
If you're enjoying this, make sure to subscribe and hit that like button. It really, really helps the channel. And definitely let us know in the comments which stock you want us to simplify next.
Okay, let's look at the bull and bear case for Rocket Lab right now.
Let's do it. Let's unpack the bull case. I think we have to start with the raw performance because the business isn't just growing, it's accelerating.
That's the key takeaway. So Rocket Lab reported Q3 2025 revenue of $155 million.
Sure.
And the context for that number is a 48% increase year over year. That kind of growth shows you demand is just surging across the board.
And the margin story is, for me, maybe the most fascinating part of this.
Well, yeah.
If you go back to 2020, their gross margins were, what, negative 34%?
Deep in the red. They were losing money on every single launch.
And now they've completely turned it around. Positive 34% gross margins in Q3.
A 68-point swing in 5 years is, that's not just impressive, it's proof of serious operational efficiency. Scale's kicking in.
And their guidance for Q4 suggests even more expansion.
Right. It does. They're pointing to maybe 37, even 39% gap margins. That trajectory tells the market the business model is working, period.
So let's break down what's driving that, because this is where that pivot you mentioned comes in. It is not just about the rockets anymore.
Not at all. The heavy lifting on growth is actually coming from their space systems segment.
So building the satellites.
Building the satellites, the components, all of it. That segment brought in $114.2 million in Q3. Up almost 17% from just the previous quarter.
Wow.
So it shows the demand for what they build is growing even faster than the demand for their launch services.
Right.
They're not just selling the ride anymore, they're building the car.
Okay, but that kind of acceleration costs a lot of money. It requires huge capital.
It does, and that's where their financial stability comes in. They have the war chest.
Over $1 billion in cash, right?
Over $1 billion. And that number is so important because it lets them fund these massive capital-intensive projects.
It's like the new Neutron rocket.
Exactly. And it gives them firepower for any M&A they might want to do down the line. Their liquidity is rock solid.
And we can see that in the metrics. The balance sheet looks really strong, a very low debt-to-equity ratio, like 0.32.
Yeah. And for anyone who doesn't live and breathe this stuff, that just means they're funding their growth with their own money, not by taking on a ton of debt.
So they have flexibility.
Tons of it. And their liquidity ratios, like the quick ratio, are almost 3.
So in simple terms, if all their short-term bills came due tomorrow,
they could pay them 3 times over without breaking a sweat. It allows them to think long-term, not about short-term survival.
Which brings us to the competitive moat, their big advantage.
It all comes back to that vertically integrated model. They control the whole process.
Let's just spell that out because it's the key to the whole thesis. You get the launch service, the Electron rocket, which has been incredibly reliable, but then you combine that with them building your satellite in-house.
And this is why it matters to you as an investor. It creates incredibly high switching costs.
Right.
If the U.S. Space Force pays you to build 18 custom satellites, it's just way easier, cheaper, and less risky to have you launch them too.
You become the one-stop shop, the end-to-end space company.
Exactly. And that protects them from the pure-play launch companies. And you can see that protection in the numbers.
The backlog.
The backlog. A significant $1.1 billion in committed future revenue. And the critical part is that 57% of that is expected to turn into actual revenue in the next 12 months.
That's huge visibility. Okay, fundamentals look strong. But the market really woke up because of one thing.
The defense catalyst.
The big one.
Absolutely. The driver was that massive $816 million contract from the U.S. Space Force for 18 satellites.
And this isn't just about the money, is it? It's a validation.
It's a huge validation. It makes them a critical national security partner. And those defense contracts tend to be very stable, very reliable.
And there's some chatter, unconfirmed but credible, about another billion-dollar deal with the Space Development Agency.
Right. If that happens, it pushes them even deeper into the most well-funded part of the space economy.
And the big money, the institutional money, they definitely notice.
Oh, yeah. Institutional ownership is now nearing 72%. We're seeing cluster buying.
So big funds taking large positions.
Exactly. TB Alternative Assets, Swedbank AB, these are savvy players making big bets on that strategic pivot.
And for anyone watching the charts, you saw that Golden Cross confirm recently?
Yeah, classic technical signal. The short-term average price crossed way above the long-term average. It just confirms that this buying pressure, this accumulation, is real.
Okay, so that's a very strong bull case. Let's flip the coin. We need to inject some skepticism.
We have to.
After a 175% rally, the number one bear argument has to be valuation, right? The stock has run so hard.
It has.
Yep.
And the price now reflects extremely high expectations. And tied to that valuation is the biggest risk. Cash flow.
They're still burning cash.
Significantly. Free cash flow is negative. Around minus $220 million over the last 12 months. That's a lot of cash burn.
But we need to be clear about why it's negative. This isn't a sign of a failing business.
No, not at all. This is intentional. That negative cash flow is almost entirely due to R&D for the Neutron rocket.
The big one.
The big one. They are taking every dollar and shoving it right back into building out their future capacity. You can think of it like a huge mortgage payment on future growth.
So you're betting on that future payoff, which analysis suggests won't even turn cash flow positive until 2029.
Right. It's a multi-year story. You have to be patient on profitability.
Okay, that leads to another risk. We mentioned institutional buying, but what about insider selling?
Yeah, that's a fair point. We have seen significant selling from the CEO, Peter Beck, over 1.5 million shares.
And that kind of selling, it can make investors nervous, right? The guy who knows the most is taking some chips off the table.
It creates a narrative conflict. You have to weigh that against the institutions piling in. Is it just standard compensation, or is it something more?
And technically, the stock is in a tricky spot right now.
Very volatile. It's been testing a key support level around $70. With the sector pulling back a bit, that's the line in the sand you have to watch. A break below that could get ugly.
So, looking ahead, what are the big milestones?
The next major one is earnings, February 26, 2026. The market will be watching for continued 30% plus revenue growth, and more importantly, if those margins keep expanding.
But the real one, the main event for the long-term story, is Neutron.
That's everything. The projected first launch is Q1 2026. The success of that launch, the timing, that determines if they can hit the scale they need to become profitable. Any big delay there will hit the stock hard.
And just quickly on the macro environment, it seems like there's a tailwind, right?
For sure. There's a sector rotation into space and defense, with everyone expecting rate cuts. That helps high beta names like Rocket Lab.
And their beta is high, like 2.20.
It is. Which just means when the market goes up, Rocket Lab tends to go up more, but it cuts both ways. It goes down more too. High beta means high volatility.
Okay, so let's synthesize this. The core thesis you're buying into is a vertically integrated leader.
Right. You have 48% revenue growth, those expanding margins, and huge defense contracts that solidify their position.
But the trade-off is clear. The long-term upside is all tied to that Neutron launch.
It is. This analysis suggests it's a multi-year investment. You're holding through those Q1 2026 catalysts, betting that this transition they've made justifies the high valuation and the cash burn.
Which brings us to our final thought for you to consider. Given the success of the space systems business, the part that's actually making money and growing fast, how is the market really valuing this company?
Right. Is it valuing it as a reliable space systems company with a billion-dollar backlog? Or is everyone still betting the entire farm on the successful, on-time launch of Neutron?
In other words, if Neutron gets delayed by a year or two, does that core satellite business offer enough protection to justify today's price? Or is Neutron still absolutely mandatory for this bull case to work?
Something to think about.
That's the lowdown on Rocket Lab for today. If you haven't already, subscribe so you don't miss our next breakdown. We'll catch you on the next one.